announced a significant growth in its annual profits. We're talking here about 45% growth in net profits last year. Which sectors contributed the most in these profits?
75% of our business is institutional and corporate, and our lending to the market, our volumes were up about 18%, which was very strong, a significant increase on the year before. But also our retail business, which is about 25% of the balance sheet, saw very strong growth as well at around 16%. And in particular, our support of the mortgage market meant that our mortgage book grew at greater than 20%. So it was really across the board, which was very pleasing for the business.
And the mortgage market constitutes what percentage of your loan book?
So it's about half of the lending that our retail bank does. So, around 12 to 13% of the total book was in mortgages, and the growth was very strong. And we're very pleased to be standing behind the vision in supporting the participation in the mortgage market.
Let's discuss further the growth in your loan book. 18% growth last year. Did it come from corporate, retail? How about the government?
As I said, the corporate book is our largest, and we've been involved in many of the giga projects and the support behind those, Red Sea, Neom and others. And one of the biggest sectors at the moment, which should be no surprise for anybody who visits Saudi Arabia, particularly Riyadh, is the construction sector is very busy, and it's a very big part of our corporate lending book. It's one of our major sectors. And there's a real focus on this for delivering the infrastructure around the giga projects and the housing market and the population growth that we're seeing in Riyadh in particular is driving all of that activity. And we're very well positioned because of the international connectivity that we have, and many of the contractors coming in are from overseas to add capacity to the local market, and we predominantly are able to facilitate the inbound EPC contractors and everything that goes with that. So as long as that continues, and I'm sure it will, it's very good for our business.
And when you tell us that 70% of your portfolio, loan portfolio, is corporate, what percentage is government?
We don't publish that exact information, but a fair amount of what we lend into could be classified as associated, depending on, for instance, PIF participation. Even when the PIF don't have majority ownership in companies, there's a connectivity. But we are very determined to stand behind the initiatives that the government is focused on and the sectors that they are looking at growing as part of the vision. As I said, construction for us is one of our biggest sectors, and it's one of the biggest programs that needs to deliver. So we are very happy with the momentum in the economy. As the economy diversifies as well, growth in the non-oil economy is growing all the time as a proportion, and that growth is very healthy, was very healthy last year at around 4.5%, and the outlook again is very healthy for this year. So it's not just construction, it's many other things, but we're enjoying that growth at the moment.
And what's your outlook for the growth potential for this year?
I think the non-oil sector growth is very solid, and the supply chain expansion, there's many things that are positive around this. The greater participation of the SME sector in the economy, the regional headquarter establishments, which is adding significant momentum in different sectors, like in technology, in digital data centers. The tourism expansion is attracting a lot of resources, and therefore it's very exciting. Riyadh needs many more hotels to accommodate Expo 2030. So there's a lot going on, and so our outlook, particularly in the non-oil sector, is very positive. And that's why, when we think about our business this year, we're expecting to grow significantly this year as well.
Tony, what was your net interest margin end of 2023, and how did it compare to end 2022?
Excuse me, it was up from the end of 22 as interest rates continued to rise. We finished well above 3 in terms of net interest margin, and it's been pretty stable here for the last 3 months or so. Some of it, that sensitivity is obviously driven by the actual rates themselves, but it also there's sensitivity in the mix of deposits. And the non-interest bearing deposit, the CASA deposits, as a proportion for the industry has been falling a bit, and that puts a little pressure on the cost of funding and can impact the NIMs. But so far, that's been quite stable in the last 3 months or so, and so we'll keep a watch on that.
So what is the percentage of the interest-bearing deposits at the bank, and how much did it increase compared to end of 2022?
The NIBS ratio, if that's what you want to focus on, has come down for everybody. We had a very healthy NIBS ratio amongst the top in the industry in the mid 70s, and now that's come down to below 60, but has been relatively stable. But as we've funded faster loan growth, we do that prudently through raising deposits, and clearly with interest rates shifting to where they are, the proportion of time deposits required to get more deposits so we can actually grow lending has gone up last year from about 30 billion of time deposits from the year before to about 100, but that extra 70 has been used to create capacity to lend into growth sectors.
Tony, the growth in your loan portfolio is higher than the growth in your deposits. What's the loan to deposit ratio right now at the bank?
The regulatory ratio that we report to SAMA is at around 75, and that's prudent. It's a little bit lower on average than the rest of the banks, which sit in the high 70s. So at 75, we are at the slightly conservative end. So we have capacity to lend, and we certainly will be focused on growth sectors again this year.